Okay, but first up, we have Jigar Mistry joining us, co-founder of Buoyant Capital, to discuss the way forward for the market. Jigar, hi, good morning. Thanks for joining us. What's your big theme? The market's been grappling with higher inflation concerns. The FI selling, of course, has cooled off. But how are you sort of mapping the cues, and what's your big call for the market? Okay, I think there's some issue with that link. We'll try to repatch that. For now, let's just look at the market. PVR is the top F&O loser now, down 3%. Remember, it's an F&O ban, so that could have some bit of implication. On the other hand, JK Cement has moved to high point of the day, 6% higher on that stock. And your PI Industries, by the way, that's also making a big move right now, 4% higher on that. Bharti Airtel, just relentless on that stock, 753 now. And very close to its all-time high. Bharti Airtel, the all-time high is 781. I think it's moved within 3.6% of that. I think Jigar is back with us. Jigar, morning. I was asking you, what's your sort of big theme that you're watching out for this market?
Good morning, Anuj. Thanks for inviting me on your show again. Basically, look, since you look at the picture since we last spoke about the start of this month, a lot has transpired, frankly. So, the Fed meeting happened, the RBI meeting happened, market was expecting 7 hikes, median dot came in at 7 hikes. But since then, very unique thing transpired. The 2 10s basically flattened to 25 basis points and the 3 10s, 5 10s curves inverted, which essentially suggests, recession. So market swung from one end of the spectrum, which is continued liquidity pumping, to straight policy error, right? And this sort of things, the markets immediately bounce back after that. And my sense historically has been that all these moves don't get sort of absorbed, understood, and, discounted in one flow. At the same time, if you look at how the Indian yield curve is trending, it's completely decoupled with the Fed curve. Historically, we have always seen US, Treasury 10-year as the mother curve for everything else. And historically, these linkages have not really transpired. Now, you started by asking about inflation, and that's important because, we import about 4.2 million barrels a day. That essentially, even if you take 110 odd number at the crude, is about 4 lakh crore. Right now, 4 lakh crore of incremental cost needs to be absorbed. I think it will be a combination of government reducing excise, OMC is not passing entirely on, and you and me paying more for gas, and also a lot of corporate profitability being suppressed. Just for a number perspective, the PBT of BSE 500 was 7.5 lakh crores. So 4 lakh crore or part of it that getting absorbed is going to be very interesting on how that happens. One another very interesting data point we came out with was that if you look at the last year, so FY22 earnings, 4 commodity companies, Tata Steel, JSW Steel, Hindalco, and ONGC, which together account for some 4% weight, is contributing to close to 50% of incremental earnings. Right? So if you look at the top 10 contributors, only one company has a PE which is higher than Nifty. And if you look at the top 10 laggards, 8 of them have a PE which is higher than Nifty. So if you're going to see a sort of contribution driven by low PE names, then one could very well argue that, you're going to have a PE of Nifty which will compress. And therefore, the whole feeling of FOMO, oh, this has happened, that has happened, and now we get back to it. I think you'll get enough opportunities to get positioned the way you want to, and take it accordingly. I think that's the preamble that what we are looking at from the markets.
Hi Jigar, morning. Nigel on this side. Been a while since we spoke, but Jigar, you're talking about, you briefly mentioned about commodities. I wanted your view on the commodity stocks. In your early avatar, you were tracking the space very, very closely. Now, obviously, you've spread out across various sectors. So what would you do from here on? Some of these commodity-related stocks at spot, they're looking attractive. But as we know in the last decade or so, we have seen, things turn and swirl quite a few times. So would you look to buy into commodity stocks? If yes, what would it be? Ferrous or non-ferrous? Go ahead, Jigar.
Yeah, good morning, Nigel. Yes, been a very long time. You are right. See, what happens is that whenever you start looking at commodity prices going from say 100 to 150, stocks go, maybe 2x. And then it corrects from 150 to 130 and the stocks come back to 1x. So it's a very difficult sector and everybody has thought of this sector as, possible trading opportunity. Our sense is that, if you look at the construct, one needs to understand on how China is actually behaving. Take aluminium, for example. China never really had a role, buying alumina, buying bauxite, buying coal to produce power and then exporting aluminum. My conjecture is that they did this because essentially they wanted to keep aluminium prices lower. And once their infrastructure is built out to a very large extent, aluminium is one commodity we are structurally very bullish on. And therefore, on the non-ferrous side, it does make a very good point to be continue to be invested. Obviously, you know the names better than me, Hindalco, Vedanta, whichever one you like better. It's a very interesting name. Ferrous is slightly a different story because, it's one, very regional. Two, the governments to some extent having promoted and supported a lot of these plays might want to come in and cap the prices. And if that were to happen, then you are likely to see a slightly subdued sort of, steel pricing scenario. So you're right, ferrous for us is not really, turning things around, but non-ferrous we are very interested in.
Okay, interested in the non-ferrous names. Jigar, good morning. Thanks for joining us. In this entire setup that we just spoke about, where there's so much happening on the global front, if you do have to put some fresh money to play here, what are the sectors that you feel are perhaps relatively safer bets?
Good morning, Kavita. I think we'll break it down into three parts, right? And, let's work with the way GDP is constructed in India. So you look at consumption. Now, with consumption, our sense is that because of the higher inflation, your earnings are going to be under pressure. And because of rising interest rates, your PE expansion, which has happened between 2013 to 2017, that might, be under check. And therefore, consumption is one sector that we are not terribly interested in. Manufacturing, selectively, it does make sense because the way, the last 5-6 years in India has happened in terms of policy action, in terms of the way companies and governments have responded, I think it could be very interesting selectively. And services, on the other hand, looks like fairly resilient given where things are. If I want to sort of broad base this, what does it mean in terms of, individual sectors, then we like insurance reasonably well. Banking, you are aware, is one sector that we think can actually generate a lot of alpha over the next year or so. Microfinance is interesting within the manufacturing. A select, chemicals, select pharma is interesting. And consumption, as I said, it doesn't really make a lot of sense for us at this moment.
Okay, Jigar, we'll let you go on that note today. Thanks a lot for joining us. You were seeing some flashes on the